And I'm Heather Branch here asking Abe for his insight on what you can be doing now as you get closer to retirement. Want to make sure that you've got that customized plan in place, making sure that your money is going to last you through your retirement years through the proper plan. And that's what, of course, Abe and his team are here to help you figure out. TheRetirementKey.com is where you can start that conversation. We also have links posted in the show notes, or again, find us anytime at TheRetirementKey.com. All right. Obviously, there's been a lot of concern by a lot of investors because of the market volatility we've seen. The tech companies that we've been worshiping and up on their pedestal, Amazon, NVIDIA, Intel, talking about laying off people.
Yes.
We're seeing their overall projected earnings are lower than expected. All kinds of weird things are going on. So when it comes down to the end user, though, of course, the investor, particularly the folks you work with, those that are getting close to or in retirement, now we got to focus on what we can do despite the market to protect ourselves.
Right.
Of course, no matter what's happening with the market, good or bad, the number one fear of retirees, Abe, is
running out of money.
Yep. So what can we do to prevent that from happening? Financial journalist Bob Powell was talking to the street, saying that one way to help prevent this fear is with guaranteed income. Here's what he said.
Longevity, the fear of outliving your assets, is a very real risk that you'll face. Equities, investing in stocks, doesn't always manage and mitigate that risk. Things like annuities, income annuities, deferred income annuities, those are tools that you could use to manage the risk of outliving your assets or the risk of longevity. So think about your expenses in retirement carefully, and then think about the risks that you'll face in retirement and what tools you use to manage and mitigate those risks.
What tools you use to manage and mitigate those risks.
Amen.
Annuities being one of those options.
Sure.
Let's discuss how we make that work for ourselves.
Sure, Heather. Yeah. You know, the traditional way to put together a retirement plan portfolio for pre-retiree or retiree is stocks, bonds, and maybe some cash. And then sprinkled in there, depending on the firm, that you work with, you might see some real estate, some crypto, some gold, silver, some alternatives to kind of even more diversify risk inside the portfolio.
Right.
Well, as a firm, we have seen years like 2022 where the entire stock market and bond market was down. In 2022, stocks and bonds were down simultaneously for the first time in 50 years at the same time. Usually stocks and bonds complement each other. One zigs, one zags. Bonds are there to soften the blow.
Okay.
But with bond funds, when rates rise, as they have 11 times in 2022 and 2023, bond values fall. And when interest rates lower, bond values can rise, right? So in a decreasing rate environment, as we saw during COVID, and as we're likely to see here into the near future, short-term treasuries, short-term fixed income could be a good place to de-risk and protect some of our life savings. Certain types of annuities, they get a bad rap out there, but there are a lot of good ones, and people just need to be educated. Fixed and fixed indexed annuities, currently with rates being high, fixed rate annuities are paying anywhere from 4 or 5, even over 5% guaranteed, kind of like a CD would, but even higher yields sometimes than a CD with the safety that someone's accustomed to in a bank CD with principal protection. Fixed indexed annuities can also make for a good bond alternative. If you think about what you would earn long-term over your lifetime on the bond side of your portfolio, it's usually between 3% and 6%. Matter of fact, every time we're sitting down with someone at our conference room table, Heather, we'll show them the Vanguard Bond ETF. That's BND, ticker symbol. Well, since inception, the last 17 years in a row, that bond fund has averaged, its annual average yield is 3%. Well, if you think about that, we're barely keeping up with inflation. Then when interest rates rise, bond values can and will fall. In 2022, that same bond fund was down, and the bond markets were down between 11 and 15%.
Right.
That's not safe to a retiree. Being down 11 to 15 on the safe side of your portfolio, or quote-unquote safer side of your portfolio, is not safe to us as a firm, nor is it safe to our clients. Our clients need and want something in there that's not going to lose a penny no matter how far the markets fall. That also means they're going to make the least amount on that piece of the portfolio. But if you think about building a retirement plan portfolio like building a house, The foundation of the house should be rock solid. Even the Bible even talks about this. The wise man building his house on the rock, the foolish man building his house on the sand.
Right.
You can't build a house on sand, people.
That's right.
The sand, there's no foundation. You need to build your house on a rock. You need to build a retirement plan on rock solid foundation. Well, that's where some annuities can come in to replace income, to be there for principal protection in the portfolio. They're not perfect. Nothing is.
That's right.
Everything has pros and cons, but they can really make for good bond alternatives.
Yeah.
It doesn't take a lot, Heather, to make more or to be in the same yield range as a bond fund or even an individual bond with perhaps even more principal protection. So we just had a couple come in from Gainesville who really needed to protect a piece of their portfolio. 3.2 million saved, a 6 on our risk scale, just middle of the road investors, retiring this year.
Okay.
3.2 million saved.
Nice.
80 to 90% of it in stocks, knowing when they came in they needed to reduce risk right away. So basically what we did is we removed about 35% of that money from the stock market, principal protected, so they could rely on 30 to 35% of that money and never worry about going down, right, due to market downturns. Yield expectations, growth expectations are typically between 3 and 5, 3 and 6, the safer, quote-unquote, side of the portfolio. Yep. And then on the more aggressive side of the portfolio in the market, you have things like stocks and ETFs and structured notes and sometimes mutual funds, although we don't use a lot of those, and things like that, the normal things people know to use to grow their money. But we can't continue to invest like we were 40 and 50 years old at the point of retirement because we can get burned, our wages are ending, and we need income from our life savings to replace our working paycheck. People get this and they realize, okay, I've won the game. This couple realized I have 3.2 million saved. They started working with us several months ago before this recent downturn. And there's no perfect time to work with an advisor, but it was a great time for them because they caught a lot of the up and protected a lot of their life savings before this recent downturn. The solution for them was that portfolio X-ray. We went over everything with them, Heather. We went under the hood on everything that they have, found out how much risk they were taking, recommended what we did, incorporated a lot of protection and a lot of other planning as well around Social Security, long-term care, and taxes. So if you say, you know what, Abe, that sounds like me. I sound like this couple in Gainesville, Virginia. I've got a few million saved. There's nothing I have that I know that's protecting me from all the risks that can mess up my life savings, including market downturns. And I want to know more about that and how I can incorporate more protection. Go to theretirementkey.com, click on the Contact Us tab at the top of that page, and we can begin to have these conversations with you as well and give you that portfolio X-ray also.
We also have links posted in the show notes. If it's more convenient, just click there. Or again, find us anytime at theretirementkey.com.